Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. The move up from the October 2023 V-bottom created a mini head and shoulders top over early November to early December 2023. When the break lower happened down through the neckline of this head and shoulders top, it also broke down through the lower bull channel line of the early October to early December 2023 bull channel. As you can imagine, breaking all these so closely associated with each other supports as they were back then required some considerable force, and prices have dropped back ever since. Though there have been some hesitation this past January, but the bearishness has been strong enough to test lows not seen since December 2021 at 1143. Going back to that hesitation seen in January, well, this hesitation created a small descending wedge pattern over January and into February, which you can see highlighted in dark blue on my daily chart. It may just be the aesthetics of it, but the way the descending wedge pattern sits makes it look like it's pointing the way lower. This observation does not back up this idea, of course. It's just an observation. However, it has been accurate in this instance. Most important of all, I drew 4 weeks ago an early July to mid-November 2023 bearish Andrews pitchfork, which I have since highlighted in purple on my daily chart. At the time, it was more as a way of expressing the bearish angle of attack here than for anything else, and in this it has been accurate in showing the way lower and the bearish angle of attack. Though I do note that prices have stayed away from the upper and lower tines since its creation. Those are currently 1270 and 1084 respectively. Instead, the market chose to stick close to the middle tine, currently at 1179, which is fine. That was until the middle of last week, and this is when it departed once at a more acutely bearish angle lower. So looking below, well, apart from declining lower tine, we seemingly have only one piece of support until the November 2020 low at 1045, and that is the 61.8% absolute Fibonacci line at 1106. You'll excuse me if I don't necessarily hold out much hope for this support right now, but I will not deny its existence, for there it is, it sits, and it's there. The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal, and that is the well highlighted annual key reversal down we saw there for 2023. Now, it's not directly related here, but it's not worth ignoring either. Chicago soybean meal. After establishing a horn top in mid-November 2023, something I cautioned about 14 weeks ago, prices dropped down through some major supports, and in the process of heading lower created two lagging indicators, dead crosses of the short medium moving average, currently at 362.20, down through the long moving average, currently at 396.40, and then also down through the medium moving average, currently at 388.40. In mid-January, prices hit the congestion zone, 363.70 to 368.80. And this was where I had cautioned 12 weeks ago we might see some hesitation due to the low we saw back in October 2023. That eventually led to that same big horn top in November last year. Well, prices sliced through this congestion, but in the process, the erosion there caused another hesitation, this time between the original congestion overhead of 363.70 to 368.80 and the next smaller congestion below around 349.20. This hesitation formed over January but broke down in early part of February. We then had a small area free from congestion below until the small congestion at 342 even, and then again congestion between 336.30 and 338.10. This latter one contains the 61.8% absolute Fibonacci line at 336.30. After a first attempt lower 2 weeks ago, the congestion support gave way in the middle of last week and dropped down to the next congestion below that, which is at 326.90. However, this congestion was different, as we have crossing through it the extension to the lower trend line, currently 327.30, of the July to September 2021 descending triangle. Now, I have highlighted this trend line in dark blue on my daily chart. Now, this may be nothing, but I'm minded after such a fall as we've seen since last November that this may, just may, see some hesitation around the 327 to 325 zone. I'm not certain on that, but it is worth considering. However, the overall pressure is still bearish, and we must now consider the congestion in January that ran into early February as a possible halfway hesitation. Question is where to measure it from. Now, the most obvious immediate point is the uptick in late December, in which case it would provide us with potential down to just a little under where we are now, in the low 320 zone. However, if we were to consider the move starting at the high in November last year, then there is potential down into the 270 zone, well below the bottom of my daily chart. It is too early to say whether the 270 zone will become a target or not, but it is worth considering. So what do we have in the way to halt this decline? Well, to be frank, not much. We have the October 2021 low sitting very much on its own at 309.30, but we really don't have much else until we run into congestion from 2020 between about 300 down to 282 even. So pay special attention to any moves down to the 309 zone, and then any moves below it should it get there. Finally, I'll raise again the one key feature I need to once again repeat and emphasize, as I have done in the past. I raised it as a possible feature 37 weeks ago, and it came about the close of 2023. It was that 2023 was an annual key reversal down year. Now, this hangs over all this market more than anything right now, and all action should be seen in the shadow of this pattern. Chicago soybean oil. The September to November last year bear channel had been the main driver lower in this market over autumn of 2023. The main congestion band between 56.34 to 59.44 was overcome by early October, and prices pushed lower, easily down through the February 2013 high at 54.15 and the March 2013 high at 51.26, though not so through the interesting 38.2 Fibonacci line of the big March 2020 to April 2022 move at 48.95. This surprising support slowed and stopped the market, turning it higher, and 15 weeks ago caused a break higher up through the upper bear channel line, and created a small bull channel. However, this 4-week-old bull channel ran out of steam, capped by the combination of the sine wave. Notice that sine wave? Sine wave that is highlighted in green on my daily chart of the declining short medium moving average, currently at 47.62. And also the same February 2013 high support that is now resistance at 54.15. In early December last year, prices broke out below this small bull channel, though the move lower has not been as easy as it was back in autumn 2023. Eventually, at the turn of the year, the market broke down through the 38.2% Fibonacci line at 48.95, and we had the opportunity to form a very extensive bearish halfway hesitation, with a bear channel being one leg and a bull channel being the hesitation, with potential being as low as 40 even. However, the decline, and we have had a decline, the decline has been shallower than in autumn last year. Interestingly, possibly being dictated on top by the now shallowly declining short-medium moving average in green. And it's consisting of 3, maybe 4 bands. These are the 44.68 to 45.04 zone, made up of the 2014 high at 45.04 and the May 2023 low at 44.68. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94. Then the interesting 42.65 congestion, which had the neckline of the October 2019 to February 2020 head and shoulders top running through it, and that's currently 42.79. And I suppose we also have congestion further down at 41.15. Now, I mention all these because some 34 weeks ago and numerous times since I said the following about the big descending wedge pattern that was on my chart back then and is high up off the top of my chart now. I said the following when I quote, "I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern." End of quote. Now, this is a big pattern idea. A market decline since autumn last year fits in with this idea, with the expectations I voiced of eventually witnessing a fall down to the area of the main June lows between 48 even to 46 even zone, which is where we've been recently. I'm now keeping a very, very close eye on this idea, as any significant break below the 48 to 46 zone could signal the start of this move lower. So far, I am not convinced that it has seen this break lower, not just yet. However, three things to bear in mind. Firstly, this is a really big pattern stretching from November 2022 to date, so do not expect any immediate sharp movements. Secondly, data indicates about 3 out of 4 times the market breaks lower. Just be aware of that. Finally, I would like to float the idea of a recent unusual bear channel. Now, I've highlighted the lower bear channel line dating from the start of 2023 in dark blue on my daily chart. That's currently at 43.86. Now, I could have drawn a second trend line, an upper bear channel line, but I have chosen instead, for now, to utilize the declining short medium moving average in green as the upper bear channel line, which is currently at 47.62. There is a simplicity about it all looking at it this way, so pay special attention to the blue and also to the green.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.